Okay, welcome to the Money View reading group. This is our third and final discussion of Perry Mehrling's The New Lombard Street. So for this discussion, we read chapters 5 and 6, the last two chapters, and the conclusion as well. So chapter 5 is all about kind of explaining what dealers do, how they make the whole financial system go, and the payment system and all of that. And then chapter 6 is really looking at, okay, well, how did it break down in 2008, and what are the lessons from that? And we've got this kind of theme throughout the book of funding liquidity versus market liquidity, and the dealers turn funding liquidity into market liquidity so that people can sell their assets or put them up as collateral in order to borrow in the money market to fund the holding of those assets. So they repo their assets out in order to fund them. So all of that kind of came to a freeze momentarily, or almost came to a freeze in the 2008 crisis. And the upshot is that we had backstops for funding liquidity kind of in place with the Federal Reserve, and we had solvency backstops with the FDIC, with the banks, but this was all kind of like backing up the regular banking system. And the regular banking system did fail, or was on the verge of collapse in 2008, and that was kind of the main thing that people noticed. But what Perry Mehrling is pointing out is that the real failure was in this market-based credit system, where dealers were providing market liquidity to assets, and people were able to fund themselves by borrowing against those assets or selling those assets. So the problem is then that's what failed, and then the regular banking system was backstopping that market-based credit system, or the shadow banking system. So then that's what caused the traditional banking system to kind of tip over into crisis. So if you're only talking about backstopping the traditional banking system, then you're missing kind of the ultimate cause of what happened, is what Perry is pointing out. And you had these institutions, these investment banks and insurance companies that were kind of providing a private backstop to the entire system, and they failed. And Perry's argument is that, well, that's not what private firms are supposed to do. That's not their job. That's the job of our public institutions. So his argument is that the Fed shouldn't just be a lender of last resort, backing up funding liquidity, so that everyone is able to kind of borrow, or on the money market, or banks are able to do that or something. But they have to, the Fed has to backstop this market liquidity system. And he draws a distinction between, well, are you really a credit insurance provider, or are you a dealer of last resort? So the credit insurance provider would be like if you were actually doing credit default swaps and ensuring that like you'd pay if the thing defaults or something like that. But if all you're doing is being a dealer of last resort, then you just have to ensure that the market price of the insurance instruments doesn't deviate too far from the fundamentals. The fundamental value of capital assets comes up a lot in these chapters, and my understanding is that what he means by fundamental value is that it's the anticipated future cash flows from that asset discounted to today, adjusted for risk. And then if you have a number, if that gives you a number in your mind, and then the price is away from that, that's being away from fundamental value. So he talks about things being away from fundamental value in one direction and then in the other direction, and it's all related to this liquidity stuff. So yeah, what are you guys' initial thoughts on these chapters? You can do big picture, or if you want to start with kind of chapter 5 and go from there, we can do that too.
I mean, a couple of kind of initial thoughts on the last point. I mean, it's true. I think that the way that he kind of discusses it, and we generally think about this idea of kind of like fundamental value versus market value, one where we think that we have some way of kind of evaluating the value of cash flows, adjusted for risk, etc. But I think during a crisis, it is difficult to disentangle that from liquidity questions, right? And this is very much like how liquidity and solvency they are conceptually distinct, but in like reality, kind of overlapping and very difficult to disentangle. And so, part of what's happening in a crisis is, not just a liquidity problem. Liquidity problem, I think, is, how a shock becomes amplified into, a broader crisis and creates contagion and these kinds of things. But often what you have in a crisis is like a genuine reassessment of like cash flows and risk and, risk value and all these kinds of things. And so I think that it's helpful to like think about it in those ways, but I think that there's still some difficulty in trying to parse those, to pull those things apart. And so, for example, when the COVID crisis first happened, like the economy was going to tank, and everyone knew that, and that's going to affect real business activity and real, future cash flows. But then, of course, it also kind of spiraled out into a liquidity problem. Fed came in and backstopped things, and we saw that a lot of valuations readjusted really quickly. And you could see that there's still very clearly like this Zoom stock was doing very well in a way it wasn't doing before the crisis, right? That reflected a change in cash flows afterwards. And so we can think of a lot of that as a lot of the kind of initial crash as being liquidity driven. But I think that in practice, it's very difficult to disentangle those things. Fundamental value is, even that is a difficult concept to really pin down. The more you get into it, market participants spend a lot of time thinking about that. So that's kind of one thing. And another way of thinking about it might be like, what is the long run value, or what is the value that you think that this will, assets will revert to over time, as they go through different liquidity shocks. Another thing that I think is interesting is in chapter 5, he, I kind of a couple related things here, but he talks about, central banks used to always focus on liquidity and not macroeconomic conditions. I think that's maybe a bit of an oversell. I think that it's true that central banks probably focused on kind of liquidity and lender of last resort facilities more. But, managing kind of the exchange rate and thinking about the balance of payments and trade and like inflationary booms, these were, concerns of central banks for, long before kind of modern macro took over and new Keynesian models and these kinds of things. When we read the Eric Monet book, we talked about internal versus external balance. When we've kind of talked about old, Bank of England, we talked about trade balances and, exchange rates. So I think central banks, perhaps focused more on this in the past, liquidity, or more explicitly in the past. But I think it's maybe unfair to say that, they were not concerned with, macroeconomic activity before the kind of advent of modern macroeconomic theory. I don't know, some other stuff, but maybe I'll leave it there for a moment and see if other people have comments or want to kind of add on.
Yeah, he does kind of frame his money view as a reconstruction of how people thought about banking in the 19th century and how they thought about central banking, and kind of updating it for today. Like he's trying to, I think he has kind of his own framework that he's trying to put out there, and then he's finding kind of the historical stuff that fits in with it and is trying to like weave a narrative together. I'm definitely kind of noticing that.
There's a great quote from Mandelbrot, the mathematician, who popularized fractals, and he said that at some point he had to invent his like ancestors and like provide a kind of mathematical, lineage that he could use to kind of give his kind of discoveries more, I don't know, cultural weight within the profession of mathematicians who, often are like, oh, well, these are just kind of pretty pictures. What do they matter? So he would go back and dig in the history in order to find something that was kind of related. And then you say, see, this is kind of further development of work that was done by, whoever. Sometimes I think with, people who kind of focus on history of money and economics and banking, there's a little bit of that going on too.
Yeah. Raphael, do you have any initial thoughts?
Sure. So for me, the book is trying to convince us of the importance of the Fed embracing dealer of last resort. But that's a bit dated, at least for me. Like, this is old news. Like I'm on board, right? And what's interesting is what's happened since 2008 and how the Fed reacted to COVID and all of that. But what's interesting to me I think it's chapter 5 is chapter 6, learning from the crisis, a theoretical framework for distinguishing between regular banking and shadow banking, right? And so he goes into how liquidity risk and market risk for the Jimmy Stewart type of bank is this, and then for shadow banking, it's that, right? Like liquidity and market risk are different. I think that's interesting because shadow banking has often been characterized as just, well, it's kind of like banking, but without regulation, right? But no, there's like some structural features having to do with liquidity risk and market risk that are fundamentally different. That's what I'm still trying to understand is, like the source of instability for bank is, the deposits being withdrawn very suddenly and having enough cash reserves and yada, yada. For shadow banks, the deposit is really a function of money market mutual funds and whoever else is like pumping money into this. Do they look different from bank depositors? They certainly seem to be more concentrated, right? There are like fewer institutions. So I think that's, that framework for me is really interesting. In terms of like what Perry would now say of, what the Fed did during COVID, my understanding is the dealers, like the Fed first try to make liquidity available to dealers. And in spite of this, like the dealers were still not really willing to buy treasuries. And as a result, the Fed then decided to buy those treasuries directly. So I think the framework is really, like Perry's framework is really relevant. First, we tried liquidity, that didn't work. We tried funding liquidity, that didn't work. Then we had to go and like directly, buy the assets. I'm still not, but that's beyond the book. I'm still not clear exactly why all the treasuries, why the market liquidity was breaking down during COVID, because I would have thought the opposite, flight to safety. And I read somewhere that hedge funds played a role in there, that hedge funds were somehow dumping all these treasuries. So that's where I'm at. It's been interesting, like revisiting New Lombard Street, which I'd read a long time ago, and like rereading it the second time, you get a lot more out of it. And rereading it in light of COVID was also really interesting. Yeah.
Yeah, I mean, that kind of sparked a few things in my mind. It is very interesting kind of rereading it. One, just like with the kind of historical, perspective, or the history that's happened since then. I mean, part of it also because of this reading group, I feel like I know a bit more of like what he's talking about, like some of the things that he refers to. I'm like, oh, well, you've read Gurley and Shaw or whatever. And so like I have some sense of like what he's talking about. I think the stuff during COVID is very interesting. People at the time kind of talked about how the Fed did lower interest rates very quickly. But in some sense, some people at the time kind of suggested like, I mean, did it how much did that really help? I mean, later in the recovery, maybe it helps a lot, but in the initial phase, it's not clear that it did much. Instead, it was all these kind of, lender of last resort facilities, or these kind of, extra programs that were focused on corporate bonds or commercial paper or swap lines or, what have you. And, there's a sense in which it felt, some of his comments here on the kind of like importance of that over kind of interest rate management felt very prescient, where, there's a sense in which, or it may have been possible that the Fed could have not changed rates at all, but rolled out all of these other facilities and us end up in a very similar place, at least initially. On the shadow banking and liquidity stuff, I think it is, you're right, that there are important kind of structural differences. It's not just merely kind of banking without regulation, right? And part of it is that in order to kind of get around the regulation, it's gone through this kind of capital markets construction where, instead of one bank holding, loans on one side and deposits on the other side, you have like a financial institution like a, money market mutual fund that has the kind of liability side of the bank, but they're really only connected through their assets to some ultimate, through some ultimate holder of the like risky assets, right? Because they're, holding generally very safe and liquid assets on their asset side. And so one of the things that I think is interesting about this also is that, like, when we move from funding liquidity to market liquidity, I think the part of the balance sheet we focus on changes more, where, in a bank, what really causes problems for funding liquidity is your liability side. You have these, first come, first serve demand deposits or things that are like them. And of course, you can ameliorate that by holding very liquid cash reserves on your asset side. But in general, we think of that kind of problem as being focused on the liability side, right? Mm-hmm. In contrast with market liquidity, I think often what we're thinking about is something on the asset side, right? We're thinking about, a hedge fund that held private label mortgage-backed securities as assets, as investment, that it thought it could, easily sell into the market and they would be liquid and it wouldn't be a problem. But instead, suddenly they, are not liquid. The market is kind of not there, or they have to make very large price concessions in order to do it. But, I think it's kind of one of many ways that there are these kind of important structural differences between the kind of shadow banking system and the traditional banking system. And the last thing you mentioned was about the Treasury sell-off in the financial crisis. This is, or in the pandemic, so many crises. In the COVID crisis, we should at some point do like a really in-depth session reading some of the papers about this stuff. But my understanding is that most of this arose from these like relative value hedge funds who basically like make markets in Treasury bonds, and in Treasury bonds and Treasury securities, and they trade, or Treasury futures, and so they trade the like little bit of difference between between the cash kind of Treasury bond and what is going on in the futures market. And in fact, I think that in one of Mehrling's classes in the MOOC, he talked about relative value trades very briefly, but he kind of talks about his interpretation of them really being about kind of creating the like relative liquidity risk in the two markets. And if so, that was incredibly prescient. I should go back and rewatch the video in which he discussed, because I don't remember the exact details. But yeah, that's a very interesting subject that we should kind of go into more detail about, because that's one that, coming back to what we were talking about earlier, a long-term Treasury bond can change in fundamental value, in part because you expect the future interest rates to change. I mean, in some sense, not even really, right? I mean, once you hold a Treasury bond, you're going to get paid. You're going to get paid whatever yield you got on it initially. the only way in which the fundamental value of it changes in a sense is that you've lost potentially the ability to sell it in the market for the same price, right? And so in some sense, it is kind of purely a liquidity thing, right? And then maybe that's one area in which we can kind of start to think a little bit more about sharpening the distinction between changes in liquidity and changes in kind of fundamental market or fundamental value versus market value.
Yeah, my sense from this book is that when Perry is talking about fundamental value, he's kind of imagining, well, if you held this to maturity and you didn't have to worry about, selling it for liquidity purposes, then how much value is it to you? And that's kind of his conception of fundamental value. So then the fundamental value of, like you said, the fundamental value of something like a treasury bond is not going to change because interest rates change necessarily, unless there's like relative fundamental value compared to other things or something like that, because it can push around fundamental value of things that do have like default risk or something.
Yeah, I mean, that makes sense. It is difficult though, because even if someone plans on holding a security to maturity, there's the question of how you're funding that, right? And so, whatever your funding is, whether it's kind of capital or otherwise, it's affected by changes in funding liquidity, right? And so, like, even kind of deep down, it feels like there's always some like entanglement between the two.
So at one point I thought was interesting when Perry says that the fundamental value of mortgage-backed securities changed, not so much because of an increase in mortgage defaults, but because so much of the fundamental value was tied to the availability of CDS. And when AIG stopped being able to write those CDS, all of a sudden, the market value completely disappeared because the fundamental value had somehow been changed, but not because of the mortgages, but more because the value was tied to CDS. That was an interesting way of framing it. So it's really the AIG collapse that is really like triggering the complete disappearance of market liquidity, or at least if I'm remembering correctly.
Yeah, that's right, because there's no, for the most part, people weren't trading the mortgage-backed securities. So there wasn't really a market for them. What there was a market for was the CDS, so the insurance on the security. So that's where the market liquidity came from. And that's where the prices came from. I'm just, like, this is not me, this is the book. But the price, if you wanted to put up a mortgage-backed security as collateral for, repo borrowing that you use to fund the holding of that mortgage-backed security, then that price comes from the credit default swap market. So when that shut down, then you couldn't use these things as collateral anymore. And then you couldn't fund the holding of them anymore. So these are things that people were intending to hold to maturity and never were really going to trade, and then they had to try to sell them all. And then it just, there wasn't really, yeah.
I see. So I guess I'm still slightly confused about the distinction between fundamental value versus market value and the relationship between the two.
Yeah, I think so. Market value is, I guess, the price you can get for it right now on the market. And fundamental value is more based on if you're assuming you can hold it to maturity, what are the cash flows that the asset is going to generate for you, and kind of discounting that to the present. So if it's going to push around fundamental value to have AIG collapse rather than just market value, then it's got to be that your calculation of future cash flows from the asset have changed. Did he say that it pushed around the fundamental? Did he say that the mortgage-backed? I don't remember this part of the book. Did he say the mortgage-backed securities lost fundamental value, or just that they lost market value and they couldn't be used as collateral anymore?
Well, some fundamental value was lost because the mortgage defaults increased. right? So when you're doing your future cash flow projections, like that's relevant. But the overnight change in market value, like all of a sudden these things were worth nothing, did not just have to do with the increase in defaults.
Right.
That switch to the market value being zero, even though the fundamental value, it's changed, but not that much.
Right.
That had to do with AIG, the swaps, the CDS. And so I guess the question is, well, did the CDS change the fundamental value? And I think we're saying yes, because perhaps like the CDS are in place as some form of credit enhancement. So if that goes away, your future cash flows could be lower than you thought.
Yeah, if you
Is that-
if you can't insure your security against credit risk, then you're going to have to start factoring that credit risk into the fundamental
Right.
value. But also the crisis was not really in any mortgages that were really going to default. The crisis was in AAA mortgage-backed securities. So there was an increase in defaults, but not really among those ones. The crisis wasn't among the securities that had increased defaults because people were holding these lower rated mortgage-backed securities and they were prepared for that, and they weren't funding the holding of them in the repo market, in the wholesale money market. They were funding them, the money market mutual funds were funding their holding of the lower tranche mortgage-backed securities by issuing their own liabilities. They were just borrowing kind of long-term. So it wasn't like, if the price does go down, it's not like they lose their funding because they kind of have everything set up. Whereas it was the people holding AAA that were funding in repo, and then they couldn't roll over their funding, and that's where the crisis was, and it wasn't where the defaults were. So my sense is that there wasn't much movement in the fundamental value of the mortgage-backed securities that were actually where the crisis was, which was the AAA stuff, and that it was all, or that it was primarily a loss in market value and shiftability. You couldn't just repo them out to fund your holding of them anymore, because nobody was expecting, and they weren't going to default, so that's fine, but you can't get as much funding if the market value happens to dip a little bit. Then you have to sell. You have to sell. If you can't fund it, you have to sell some of your position. That drives down the market price even more. So you have this liquidity downward spiral, and everyone's still making their mortgage payments.
Yeah, I mean, so let me push back on that a little bit. I think in general, I agree with the spirit of that, which is to say that, much of the problem is in large part a question of kind of liquidity. That said, I mean, another story that you could tell in order to kind of bring the kind of AIG and CDS aspect of it into the fundamental value is that, whenever we're thinking about the fundamental value, we're thinking about, future discounted cash flows. And that discounting is, in part adjusting for risk. And so, the extent to which you can insure against something should, of course, change, how much risk or, how much you need to be compensated for risk in something, right? I mean, if I can insure against holding, I guess your point is that it's not even the risky ones that we're getting a lot of CDS, but I don't know. I mean, it's a little difficult.
They were all getting CDS, but the sellers of the CDS on the risky securities were not under crisis, because they were all anticipating that, some of these might default, right? So they were prepared for that.
Yeah, but I mean, just in general, if insurance is available for something, then that should help reduce your risk weighting when evaluating the fundamental value of something. So I think this is interesting because then it relates a little bit back to kind of some of the broader kind of philosophy that I think Perry is working towards later in the book, which is to say, what is the role of the central bank? The central bank, shouldn't be there kind of trying to target the fundamental value, but it should be kind of, and not insuring against all changes in value, but ensuring tail risk, right? And one of the things that I think you often hear from people is that, oh, central banks are just bailing out the markets and blah, 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 blah. I don't know. I mean, that may be the case in some instances and may not be. I'm often skeptical of people that make those arguments, but I can be convinced in some cases. I think that in relation to what we were just kind of talking about, if the central bank can ensure against tail risk, particularly by kind of making liquidity risk more both funding and market liquidity risk in extremis be truncated. If it can do that, then that should increase the value of assets, their fundamental value, right? Because we've reduced your how much you need to be compensated for risk in those things. And so by setting kind of an outward, an outside spread or bound, taking care of a certain degree of tail risk, asset prices fundamentally should be higher. And there's nothing necessarily wrong with that, in my opinion. I mean, that just seems like we're living in the good world and in the good place rather than the bad place, and of course, I have concerns about inequality and all these kind of things, but those are separate questions. Those are more or less like fiscal questions, which are very important, but are not like the central bank has an ability to keep us out of a bad equilibrium, and that's good. We should use that,
Yeah. Yeah, go ahead, Raphael.
No, I was gonna say that, like, going back to the book, the Bagehot's rule, the idea that you do have to have some discipline, and that's typically the interest rate at which the central bank is willing to finance these assets. I'm confused how to reconcile that with what's happening right now with these kind of rock bottom interest rates. Have we lost the discipline? Like, what would Perry say? Do you know what his argument is?
I feel like, I think in general, he does feel that way a little bit right now, at least in the last kind of couple of things that I've read from him and discussions. I get the sense that he, often feels that there's maybe a little bit too much elasticity and kind of activism from central banks. But I don't know. I mean, I guess it would depend on the specific. I feel like in reading this text, I would almost feel like those two things could be a bit disentangled, which is to say that you can have lender of last resort facilities that have a material kind of discount or kind of penalty rate on them, and still set your kind of general macro broad interest rate policy to be something different than that, right? And so I think he kind of talks about then how really there are kind of two tools and two objectives of the bank. One is kind of lender of last resort, and the other is kind of interest rate and macro policy. And if we take it from those perspectives, then in theory, there's no reason that kind of higher or lower interest rates for macro policy should affect how kind of how much of a penalty rate there is for these kind of lender of last resort type facilities. I quite like, and he doesn't explore it here as much, and some people have started to explore it a little bit in some other areas, but I think it's very interesting. He kind of has this idea at the end about having these kind of like standing facilities where kind of any security or asset or whatever could be brought to the central bank at some kind of premium, or where they have to pay some kind of premium, and that would set kind of a perpetual outside spread. And in only a small way, the Fed has started to do this with like a standing repo facility, right, where in theory banks can go to it and exchange reserves for treasuries anytime they want, and you could imagine things like this for other securities. Like the discount window in some sense is supposed to do this, right? I mean, you can take commercial loans to the discount window and get funding from them at a premium or for a premium from the Fed. now it's not really used in part because there's a lot of stigma and problems associated with that. But you can imagine like an updating, like this is another sense in which, Perry kind of is hearkening back to kind of olden times. I mean, that's the way in which central banks, primarily operated for a long time, is through these discount window facilities initially, and banks would, bring their bills of exchange and get them discounted from, the Bank of England or what have you. And so you can imagine an updated version of this that, allows other non-bank participants. It includes, other financial securities, and this kind of a range of discounts and premiums depending on, how risky they are and this kind of thing. To the extent that something like that is kind of always ready and available, in some sense, you should, never have a crisis, right? I mean, which is, of course, there'll always be some other way for a crisis to happen. But that you would never have a fear or concern. You would always know what like the minimum you could get for it is. There would never be some uncertainty about the like furthest reaches of potential illiquidity.
So it's like the Fed as providing the outside spread to ensure against tail risk.
Yeah, if it just did it like
as a good thing. Yeah.
Explicitly all of the time,
Yeah. The only question I would have though is there a possibility that by insuring against tail risk, the Fed is actually changing the risk distribution in a kind of reflexive manner, so now the risk increases, or I don't know.
No, I mean, we read a book, what is it? We read a book last year that was related to this called
like The Rise of Carry.
Yeah, The Rise of Carry, exactly. That was kind of the argument of The Rise of Carry. And yeah, I mean, maybe that's true. I'm a little, my opinion is a little bit like, well, if the Fed is going to kind of, or central banks in general, are going to end up backstopping these things anyways, it's better to like prevent the crisis in the first place. And that it's not obvious to me that it has to spiral out of control, as opposed to being a one-time reassessment of like, oh, well, now there's less uncertainty, and so certain things are, worth more or less based on that.
Yeah, and Perry was clear at the end of the book that he didn't want the Fed to be a credit insurer of last resort. So he didn't want the Fed to be insuring against default. He just wanted, and maybe this is one of those things that can be tough to untangle too, but he wanted the Fed to be ensuring the shiftability of these credit default swaps in the market at kind of what their fundamental value would be, or some discount to their fundamental value. So there's like a penalty rate of shifting to the Fed, but you always can, or something like that. As opposed to if you just have a credit default swap and your asset, maybe combined they have the same fundamental value as if the market value of your asset didn't go down, but you can't post the CDS as collateral in the repo market, so the amount you can borrow is still less. Whereas, okay, I'll shift it to the Fed and get a treasury, and now I can repo that out and still fund my position at 80% or something.
Yeah, I mean, I think George Selgin has put up kind of proposals for, because a lot of people have talked about standing repo facilities for kind of like the treasury market and stuff, and that's kind of what they have now. But I think George Selgin has talked about standing facilities for kind of a broader class of assets as well, in a way to kind of make the current kind of system, which is very kind of ad hoc and only in crisis times, be a little bit more regularized and kind of transparent in a sense.
I've kind of a side question about the discount window that you might know the answer to. When so when Perry talks about the discount of the Bank of England in the 19th century, you've got banks that are just selling the asset to the central bank at a discount. and the central bank holds it to maturity. Whereas I feel like today with the Fed, it's more of a discount loan. Like you're putting up collateral and then potentially getting it back or something like that. I'm wondering.
They were loans. I thought they were loans to the Bank of England too. I could be wrong, but I don't know. Maybe they're loans for the maturity of the bill. But yeah, okay. Maybe that. See, this is one of the things that's always a little bit complicated with some of this stuff for me, is that like, like lending and ownership are like kind of ends of a spectrum, right? And if you like loan against something for its maturity or whatever, it's pretty similar to just buying it. But I think,
Right.
and I could be wrong, but I think that the way the old discount window facilities, say at the Bank of England, used to work, that you'd get, a bank would take their bills of exchange and give it to, the central bank, and the central bank would loan them money against it. And I think that basically they would get money for like the term of the bill of exchange. Now, I'm not 100% sure on that, and we should read one of these like history of central bank books to understand better. But in that sense, the loans from the central bank are like self-liquidating, right?
Yeah, I was thinking it was the bills of exchange that were self-liquidating. So the central bank would buy it at a discount and then it would liquidate and they would get the payment, and you wouldn't be talking to the person you bought it from anymore.
Yeah, I thought it was kind of like both, right? And maybe I'm wrong, but I thought that I thought that the Bank of England lent against the bills of exchange. I thought that part of it was that it lent against them because they were short term, and so they would be liquidated, and the central bank's balance sheet would kind of come right back in.
Yeah, I guess it's somewhat equivalent, as you say. All right, I was hoping maybe there was like a clear, obvious answer, but I think I'm fine.
Yeah, we'll do more on the one of these like history of central bank books at some point.
Yeah. So I do have some balance sheets drawn up. I also have some excerpts from these chapters. So he talks about imagining a world in which the central bank provides, this is in chapter 5, in which the central bank provides perfect market liquidity to everything. And then there's no profit motive for dealers anymore because the central bank has kind of taken that onto their balance sheet. And then you also have potentially a problem where dealers would have an incentive to increase leverage perpetually because the expectations hypothesis of the term structure just holds. So there's no reason, or not, it wouldn't be, let me read this. Suppose hypothetically and counterfactually that there were no such limitation, as long as the expected profit, this is page 100, as long as the expected profit on the term structure was positive, dealers would have an incentive to increase leverage, buying bonds and selling bills. Competition among dealers would drive profit on the term structure arbitrage to zero, and expectations hypothesis of the term structure would come into its own right. Okay, so the question is, he's saying that would be bad. And that's because there wouldn't be appropriate constraints on the dealers. Oh, thanks, Martha. Oh, I guess she's up. Okay. Yeah, I'm just trying to get more of an intuition for this. So the Fed takes over, provides perfect shiftability to all assets. What happens then? I guess there's no reason for anyone to lend long anymore because they're going to get the same interest rate anywhere on the term structure. But there's no need to. Because, what's that?
Can you say that again?
Well, if you have a perfect expectations, if the expectations hypothesis holds, then I have no incentive to lend for a long term because I'm not going to get a higher interest rate for that. But I also have no necessarily any benefit for lending short term because any long-term lending would be perfectly shiftable anyway. So it's kind of all moot.
Yeah, I don't know. So I mean, so when we're talking about kind of like the expectations like hypothesis of interest rate term structure, often what we're thinking about is like a safe investment, like a bond, like a government bond or something, right? And it makes sense that that is kind of pretty much purely a function of short-term rates and to some extent inflation and risk of short-term rates changing. But with kind of private lending, it's a little less obvious. And yeah, I mean, there's also this kind of like outside option of what other investments there are. And so you may still require people to pay you more for a long loan, even if interest rates are going to be constant forever. Just because there are other things that you could invest in, other opportunities will come up, and it's always better to have your money now than for potential opportunities. Then so I'll just say that I think there will still be long-term lending. It may not be just kind of harvesting the like positive term structure.
Right. Okay. Yeah. So I guess it depends on what the Fed is actually ensuring the shiftability of. If they're only ensuring shiftability of treasuries, then you still have all these other markets. Yeah. He talks about how the Fed is limited neither by profit considerations nor survival constraints. So they could do a lot more of this term structure arbitrage than a private dealer would feel comfortable with. And that's an interesting, so is it really true that the Fed is not limited by some kind of survival constraint, or maybe something analogous to a survival constraint?
Yeah, I mean, that's interesting. I think often the way that people would think about it is that it's limited by, well, the two things that come to mind are, or potential things that come to mind are inflation and exchange rates, right? And so you need to make international payments or lots of them, then that's a constraint. And if you think that monetary policy is going to create a bunch of inflation, then that's also a constraint. I suspect that with like the lender of last resort type of facilities, that those are typically not really binding. But I think when you're thinking about kind of more general macro policy, they may be.
Yeah, that makes sense. So when he's talking about monetary policy, he says the inherent instability of credit operates, this is page 110, he says the inherent instability of credit operates, after all, through a destabilizing feedback between expansion of credit and rising market price of collateral. The money view does not tell us which asset prices to watch, which asset prices the central bank should watch, since the dynamic can occur in commodities, financial assets, and even real assets. So he's talking about bubbles emerging. Real assets such as land and houses, we've got to be watching them all. By contrast, Taylor rule says we don't have to watch any of them. We only have to watch the index of consumer prices, which doesn't include any asset prices, and that can be a big problem. So I think this is, what is the Taylor rule trying to achieve? Is it trying to prevent bubbles? I maybe indirectly, right, through some kind of Irving Fisher argument about inflation being tied to unstable financial markets or something like that. But it feels like what Perry really wants is he wants the central bank to be having a different goal or a different objective than maybe central banks do today. So he's kind of starts with the assumption that, well, if your job is to maintain or manage the instability of the financial sector, then it's silly to be targeting consumer prices, which have nothing to do with that. But I think there's also, we talked about this maybe last week, how there are these objectives that you need in your economic policy that don't have anything to do with financial stability, and maybe inflation doesn't have that much to do with asset bubbles or something like that in terms of consumer prices anyway. But we still, so here's a question: if the Fed only targeted financial stability, financial instability, and they didn't pay attention to consumer prices at all, would that be a problem for the economy? And would they even be able to achieve financial sector stability, and if the price level is kind of out of control or something like that? So I don't know. I think in some ways managing inflation is Perry is brushing that off a little bit. But maybe the proper institutions to manage the price level and the monetary standard, maybe that's not the central bank. I don't know.
Yeah, I mean, I don't know, inflation is a difficult topic. I mean, as you know, I guess you spent a year reading about it, which,
Yeah.
I didn't focus so exclusively on. A couple thoughts on this. First is that, I mean, towards the end of the book, he kind of says, well, the Fed really has kind of two tools, or central banks have two tools and two objectives. So like, there's no problem, right? But then he also suggests that there needs to be some kind of primacy of focus on like liquidity and credit and finance.
Right, and he also says that both tools affect both objectives. So it's not like you've got one
Yeah,
tool that does one thing and the other tool does the other thing.
yeah, exactly. I think it also relates a little bit back to our kind of previous conversation, which is even outside of the lender of last resort kind of activity, you can have different kind of macroeconomic philosophies, right? And like, there is kind of the traditional one, or the one that is kind of common in modern academic macroeconomics, which is that inflation is the result of excessive real activity and too tight of labor markets and Phillips curves and these kinds of things. And then the view that I think he's a bit more focused on, which is kind of like a Hawtrey or Minsky-esque one, which is that kind of an inflationary boom is more likely to come from kind of like the credit cycle and from this kind of development of finance over time. And so that's another sense in which, I mean, even if we kind of have this clear distinction between the kind of lender of last resort and liquidity stuff and the kind of macro stuff, which I'm not saying we do, but even if we did, I think he still has kind of a bone to pick with on the macro side, where it seems like he wants to focus more on kind of credit cycles, for example, than say, the Phillips curve. And he may be right. Like, there is a lot of criticism of the Phillips curve and similar kind of, views of the business cycle. And so, that said, it is a very different perspective than, and one that I think that he would be right to kind of say has had kind of fallen out of favor a lot. I mean, I think now central banks are a bit more on the ball about that, but the profession itself, the kind of guiding strategy and philosophy, I think is still not there. And I think I'm not sure it necessarily ever will be. I mean, there's a lot of pushback back and forth. I mean, people like Bernanke, for example, have continued to argue that stopping a kind of an acceleration in the financial sector and in lending and these kinds of things in the end may not really help all that much, but may hurt a lot. Because I think there's still kind of a lot of debate about the relative kind of merits of those two approaches. Anyways, that's a bunch on that.
Yeah, it's interesting because I'm also not really an aficionado of the Phillips curve. I guess, I don't really I'm not too worried about employment, and yeah, I don't know. But in terms of having a monetary standard, and having a stable purchasing power for that standard, I like to argue that, okay, well, you need something at least reasonably stable in order to use it as a standard. Otherwise, it's not a very useful monetary standard. And I would argue that, okay, well, if it gets too unstable, people will switch to something else. And I was actually starting to read Financial History of Western Europe by Kindleberger, and he was talking about 15th century Europe and how all the gold was flowing to Asia and the Middle East because they were buying the products from there. And they ran out of gold, and it didn't cause the price of gold really to go up at all. They just switched to using other things as their money. And in Germany, the princes were calling bankers peppermen because they used pepper as their money. So it's like this kind of automatic, like I could pay a little bit more for gold to get the gold to flow back to me, but then I won't be able to buy as much of the stuff as I could get with this pepper or something like that. So there's this kind of mechanism where it's, yeah, you don't have, I guess naively I was thinking, oh, you don't have very much gold, that's going to cause the price to go up, and it's going to cause, deflation and perhaps gold inflows or something like that. And that's kind of what we read about with pottery and stuff like that, but maybe not always. So you can ask the question, well, what makes a standard sticky in the face of deflation or inflation or exchange rate movements and stuff like that. There's some interesting stuff in there about bimetallism too, because I used to kind of think, well, bimetallism is a failure because you can't have both going at once. But then Kindleberger talks about how, well, the standard, you have a bimetallism officially, you have these two metals, and then whichever one is overpriced is the one that ends up being the money that everyone uses, like a Gresham's law thing, and then it might switch to the other metal at some point. But I feel like that's kind of like the gold and pepper thing, right? Like you just switch to whatever's available. And there was this kind of, so I'm thinking about this stuff more. Clearly today, like it would take a lot for us to get off the dollar. Like a little bit of deflation, I guess they're mostly talking about deflation there. A little bit of deflation is not going to cause everybody to leave the dollar, probably.
I mean,
I don't know.
In general, I suspect that inflation would be the more likely thing to drive people off the dollar. And I think, I think at some point I had recommended the book, and we might want to take a look at it at some point, but there's a good book called like Global Currencies by Barry Eichengreen. And he talks about what some of the main drivers are for kind of whether people use one currency as kind of a reserve currency or for transactions, these kinds of things. And he argues that, a mix of kind of inflation and lack of financial depth and these kinds of things were a big part of lack of financial depth is hard. An increase in financial depth in the alternatives were kind of big factors that contributed to the transition from pounds to dollars. But here kind of bringing it back to this, I guess your question then is like, what is the Gresham's law if you have kind of what I think you call like an inflation standard, right? And I guess I don't know, then it's kind of switching between two fiat currencies depending on their inflation, I guess, which I think is consistent with the data at least.
Yeah, I guess it's the question of what would knock the global economy off the dollar standard is always kind of interesting.
Yeah. I mean, we should definitely do some more reading on kind of it is like international like reserve currencies and these kinds of things. It's a very interesting subject.
Yeah. Well, there's also an interesting passage in here about credit easing versus quantitative easing, and he says, this is page 124, Bernanke and his supporters talked about credit easing, Fed lending, while his critics talked about quantitative easing, Fed borrowing that expanded the reserve base. So reprising a largely irrelevant pre-crisis debate about the relative importance of the credit channel and the money channel in transmission of monetary policy. Meanwhile, the fact that the Fed's balance sheet had expanded on both sides tells us something else was going on. The Fed was moving the wholesale money market onto its own balance sheet, stepping in as a dealer of last resort for the money market. So it was just kind of, you had these balance sheets out there that were doing this, and then they stopped doing this. So then the Fed's balance sheet started doing it. And that's a completely different perspective than either. And I never really I knew that Bernanke had talked about credit easing, but I didn't really know what the distinction was between credit easing and quantitative easing. Was it two different ways to spin the same policy? And maybe in a way it was, but really one side, the credit easing, was talking about the asset side of the Fed's balance sheet, and the quantitative easing was talking about the liability side.
I mean, well, 100%.
Yeah.
So when the Bank of Japan kind of did some quantitative easing a very long time ago, before the global financial crisis, it explicitly talked about kind of increasing the monetary base and called that quantitative easing. And so then when Bernanke introduced what we now call quantitative easing in the US, he called it credit easing and tried to make this distinction very clear. Bill Dudley had a couple really good speeches where he talks about, what's important is what's happening on the asset side. But the media just took the quantitative easing term and went with it. And so, eventually people just stopped fighting and were like, fine, this is quantitative easing.
Yeah, so I guess this book was written when all of that was still fresh as well.
Yeah, exactly. I'm gonna have to head out soon.
Okay, why don't I stop the recording now?
Cool.